Hello everybody, this is TJ, and I thought it would be a good idea to go through some of today's trades. It was a great session. Today is election day. I hope everyone got out and cast their ballots. This is your chance to make your voice heard. So hopefully you did that. In the meantime, yesterday and today have been spectacular trading days, and I'm not going to go through yesterday's trades because you can review the session that we had in the trade room. I recorded it and I put it up on the Owners Club for everyone who's interested. So I thought I would go through today's trades, talk you through what happened. Let's start with the pound US, a 5-minute chart. The same plan that we do in the trade room. We use trend mode. When the line is red, you go short. You can see that there are some gray trades, some full color trades. When the trade is gray, as in this case here, typically means that there's some filter that is preventing that trade. This one's pretty obvious, right? The line is red, you can't go long. You have this gray trade here, the line is red, you're supposed to be able to go short, but if you look down below, you're in the chop zone. So that trade gets filtered out. They ended up being winning trades. I mean, there are some times when trend mode will filter out some trades. This was all before our start time. In fact, if you go back earlier, you could even see the European session starting right at 2 a.m. Here we are at 2 a.m. and it triggers in and you get this nice long trade here. And you can see that was good for 12 pips to target 2, 16 pips to target 3, and then, of course, the trailer. Any target that's less than 10 pips, I'm going to take that part of the trade off at the next target. So in this particular case, when the trade is only 9 pips, I'm going to take that part of the trade off at the next target, so long as it's more than 10 pips or more. So like this, you at least can cover some spread and make it worth your while. These trade plans are all designed to take 25% off at target 1, target 2, target 3, and trail, provided that a target is 10 pips or more. Now, if you're trading a market where the spread is higher, maybe you need to ask for 11 pips or 12 pips to a target to help compensate for the additional spread. All right, so that's the basics of the trade plan. It's really straightforward. We start at 8:30. You might want to start sooner. You might want to trade the session between the European session and the U.S. session called the bridge session. You can see there was a nice short here. But for us, I'm typically tracking from 8:30 on, and if there's a news event, you want to stand down. Use forexfactory.com. Look at their event calendar. All right, so we're looking for a trade at 8:30. Here's one at 8:20. Quick look at the Forex Factory. You can see that there is no news event that you need to worry about at that time. Okay, so we don't have to stand down. So 8:30, we're getting in sync. It triggered in at 8:25, so when it comes down and pushes down here, you can see that you can get short right on one of these bars as it pushes through. All right, if it spikes through, I usually adjust around the spike, like on this bar here. But then when I look to the left, there's another one. I look to the left, there's another one. So there's no point. You just take the trade when it hits the entry. It pushes through. Target 1 is too small, so that part comes out at target 2 for 11 pips. So 50% of your trade comes out at 11 pips. 25% comes off here for 15 pips, and then it trails down not too far. It was a modest gain, but it was one and done. It's all relative to the size of your trade. If you're putting on 2%, you're able to take advantage of these targets. You're done. That's it. Let's go on to the next market. And since we're in Forex, let's go ahead and stick with the Euro US. Again, 8:30. Now, it looks like you might be able to get in sync with this trade here. The only thing is, keep this in mind, and the rule I like to follow is when there is a new setup, that cancels the get in sync setup. So when this new setup comes in, you're no longer trying to get in sync with this one. I mean, that's one way to do it. It keeps things simple. That's how I do it. It worked out in this case because there was another trade here as well. That would be the one you would focus on. It never triggers in, and it prevents you from getting in sync on that one. So always go with the newest. Instead, well, you end up with this long trade. sets up at 9:35, triggers in at 10 o'clock, up and down, up and down. It ends up stopping and reversing. So the long trade gets in at 10:49. I mean, if you adjust that up to 10:50, you're going to get filled at 10:52. Stops and reverses at 10:42. Maybe you make a little adjustment on that like I usually talk about, and you're going to get short at either 10:40 or 10:39. And you've got some small targets, 60, 90, 12. So you're going to take all three of those off at target 3. So 75% of your position comes off at target 3, and the rest trails down for a pretty nice gain. So I think you're positive in that sense. Yeah, you end up ahead a little bit, but you're not one and done. You're two and done. Power of quitting, full target winners, positive result, done for the day. Remember, the whole goal is to grow your account. You want to quit positive on most sessions, taking what the market wants to give you. Some days will be more, some days will be less. But like this, you consistently grow your account, which then leads to being able to grow your position size, etc., etc. Let's look at our futures trades today. All right, I'm going to start with DAX futures because, this is a really good one. First of all, for those of you that trade the DAX, 9 o'clock in the morning, Eurex time. I'm sorry, it starts at 9 a.m. Eurex time, exchange time. You've got a long trade here right at 9 a.m. It comes down, then it comes back up. It's using trend mode, so it comes off for a bar, but comes back on, and you can get long right there. Okay, and target 1 is 33 ticks away. That's 16.5 points. Don't forget, every point is 25 euros. And it pushes up, hits target 1. The stop starts moving up. Doesn't quite get to target 2, and it comes down and stops out for a partial. That's a pretty good profit. I mean, if you wanted to stop right there, that's fine. So much depends on your trade plan. I'm typically tracking either a target 2 winner or something very close to a target 2 winner and two target 1 winners. So that's a target 1 winner. Need another trade. It does get short. It's a filtered out trade. The chaser setting chases it down. I have it set to 4 ticks, 2 points. So, and the reason why it comes back on is because the directional closes red for 1 bar. And so it comes up and you get short here. And unfortunately, it's going to fail and get long, but it cuts the loss in half, right? Because the stop is way up here. So you get in with a partial loss. Maybe you make a 2-point adjustment, triggers in, and then zooms up to another target 1. Okay, so that's 2 target 1 winners. You're definitely positive, and that would be power of quitting. If you weren't positive, maybe you need one more trade. You've got a short right here, and that's going to come down and hit target 1 and target 2. So not too bad. Nice session. Let's go ahead and look at what happened during our U.S. session. So crude oil starts first. We'll look at that one first. 8:50 New York time. It's exchange time. So we're coming up to our 8:50 start. And you can see there is a short trade right there. It's at 8:43. And right here it stabs down. It's 8:46. We can get in sync with this. But since it already touched the entry, already touched the entry at 74, I'd be putting my order in at 73, right? Make it push through just in case. And it does right here. So it gets short, and it's a fairly small trade. And now that target 2 is 7 ticks because I made an adjustment, I'm really not interested in a 7-tick trade. I'm not interested in an 8-tick trade, but I'll take it. But with the 1-tick adjustment, I'm going to go to the next target, which would now be 11 ticks. So that becomes your target, target 3. And it goes up, it comes down, and ultimately pushes through and hits. Doesn't quite hit. It's gone past target 2, and it's gone 10 ticks. So the stop is now moving down, but ultimately it does push through and hit target 3, and then trails down to here. Now, you can stop out here and you'd be perfectly justified. I mean, that's where the stop is. But if you look to your left, well, first of all, look at the stops at 66. Now, if you can incorporate this in your trading, let the price action tell you things. Sometimes on your chart, you'll be able to identify some near-term support and resistance levels. When you look to your left and you see that the bar spiked up right here, I'm going to put some arrows so you see right there, well, that spiked up to 67. So why would I put a stop at 66? For me, I'm going to make a 2-tick adjustment, which is perfectly justified, and I'm going to put my stop at 68 because the price action told me that is a possible near-term resistance level. So instead of putting my stop right in front of it, I'll make a small adjustment. We're talking 1, 2, maybe 3 ticks. Depends how big the trade is. 2 ticks, you don't even have to think about it. From 66 to 68. Notice that it stabs back up and it hits 67. That's the exact level of that spike. And then it's rejected and pushes lower. So by making a 2-tick adjustment, and that is permissible, that's part of the trade plan. That's how we do it. We've been doing it like this every time for 2 straight years. So for us, this is not like, some discretionary thing. This is actually a mechanical rule that we follow. And once it hits down here, you get the reading of 63. Now you could push your stop down or leave it, right? It hasn't really changed. I would leave it. But then it pushes lower. And once it starts pushing lower, you continue to move your stop lower. And then the next trade, which is being tracked by the calculator, is now being trailed properly by you see how it's trailing down because of this trade? So we can just borrow that stop. Now you could do the same thing. Your stop's at 52, but you look to your left, it spikes up to 53. Why not put the stop at 54? Maybe it'll lead to a bigger move down, just like we just saw over here, right? Would you rather get out here or down here just by risking a couple ticks? You're already profitable. Remember, the trade is way back here. So you're just, you're making small risk for possible high reward decisions. That's always a good thing. And so it does push down a little lower, you see? And again, you could push it above as each spike forms. Keep the stop and hide it above the spike. Ultimately, it's going to stop out. And that's a lot better around 53 or 54 or even 56 than 66, right? It's another 10 cents. That's $100 a contract. All right, so remember when you're trading, take advantage of the ability to trail. Let the price bars tell you what's happening, right? Near-term support and resistance happens just based on the spontaneity of the market. So you want to be able to, like I always say, dance with the market. Let the market be the ruling dance partner, and you just go with the flow. You'll always do better that way.